In this video, we'll talk about present value, which is one of the most important tools in finance. In essence, here we want to talk about the time value of money, and here are two definitions. The present value of a future sum is the amount that would be needed today to yield that future sum at some prevailing interest rates sometime in the future. Now, the future value of a sum today is the amount of the sum that a sum will be worth at a given future date when allowed to earn interest at the prevailing rate. Now, let's think about these two concepts through some examples. Now, let's think about a simple deposit. Let's suppose that today you have $100 and you can put them in the bank and receive a return of 10%. This is in decimal form. Let's think about how that balance will grow in that bank account over time after year 1, year 2, year 3, and so on and so forth. So assuming that you want to keep the money in the bank for that long, after the end of year 1, your balance after you earned your interest will be the $100 that you started with plus the interest that the bank owes you, which is your same $100 times your interest rate. Because the interest rate in that case is 0.1, this is 100 plus 100 times 0.1. That's equal to 100 plus 10. Now, again, supposing that we want to leave that balance in year 2, you're going to start with $110 and receive your interest. That's going to be equal to 110 plus 11 for $121 at the end of period 2. Now let's think about what would happen in period 3. We'll start with 121, and you're going to be paid the interest you're owed for that year. That's equal to 121 plus $12.10. And that will be a total of 133 with 10 cents. Now I hope that you see the pattern here. In the first year, we started with the initial value, let's call that the present value, and we're multiplying it plus, well, let's actually backtrack a little bit, and we are summing that present value to the present value times your earnings here. So this is your initial balance, and this is your earnings. We can abbreviate those two by multiplying the present value times 1 plus r. Now, the year after that, we're going to take what we earned the previous year, multiplied by this growth factor again, and we can summarize that expression as the present value, again, of the original deposit times 1 plus r to the square. We can do that again. And we can simplify that expression as the present value, again, of the original year times 1 plus r to the third power. Now, as you can see, there is a pattern to this mathematical expression here. So let's generalize that to say that the future value of a sum, present value today, is equal to that present value times 1 plus r to the power of t for it being compounded t periods into the future. Now, from this, we can do some algebra to also think about the present value of a future sum. Now, from that expression, we can solve the present value of a future sum as equal to the future value, again, t periods in the future, divided by this growth factor. So we can think about what our initial balance today will be in the future, or what the present value in the future is going to be worth today. Let's think about that second concept and how to use it. So suppose the interest rate is 6%. Should you spend 100 million to build a factory that will yield 200 million 10 years from today? So from this perspective, you need to think about how to compare a sum of money today, the 100 million, to a future sum, 200 million in 10 years. So let's think about the present value of 100 million today. Well, the present value of 100 million today is simply 100 million. Now, the present value of 100 million, or 200 million, 10 years from today is 200 divided by 1 plus 0.06 to the power of 10. That is equal to 112 million. What that says is that 200 million 10 years from today would be the equivalent of 112 million today. In other words, if you wanted to get 200 million 10 years from today at an interest rate of 6%, you would need to put $112 million in your bank account today. Now, because 112 is greater than 100, it is beneficial in this case to invest the money and make 200 million 10 years from today. In present value terms, your profit would be 12 million. Now, in this case, let's see what happens when the interest rate increases to 9%. Well, the present value of $100 today is $100, and the present value, $100 million today is $100 million, and the present value of 200 million 10 years from today is equal to 200 divided by 1 plus 0.09 to the 10th power. And this is $84 million. So if the interest increases, in this case, would be much better to just keep your $100 million and put them in the bank and letting them grow for 10 years rather than investing them, because the equivalent would be $84 million today. So in here, we see an important relationship between the interest rate and the present value of a future sum. As the interest rate rises, the present value of a future sum decreases. And that's because, in essence, the time value of money calculation is telling you about two alternatives. On one end, you could leave your money in the bank at prevailing interest rates and letting them grow, or an alternative investment opportunity that's going to yield a future sum that will be compared to the deposit. Depending on which sum is greater, you can either keep them in the bank at prevailing interest rates or take that investment opportunity. So, I want you to give it a try. You're thinking of buying a 6-acre lot for $70,000. The lot will be worth $100,000 5 years from today. Should you buy the lot? A, if the interest rate is 5%, or B, if the interest rate is 10%. Please do all your calculations and submit your answers on Top Hat. All right, so you're thinking about buying this lot. Let's think about scenario A. So should you buy the lot if the interest rate is 5%? Well, the present value of $100,000 from 5 years from today at a 5% interest rate is $78,350. So the present value of the lot is bigger than the price of the lot. So yes, buy it. On the other hand, should you buy it if the interest rate is 10%? Well, the present value of the lot is $62,090. So the present value of the lot is smaller than the price of the lot. In this case, you would be much better putting those $70,000 in your bank account. That takes us to an important concept, asset valuation. How much is an asset worth? Well, in essence, an asset worth is the expected future cash flows that it might provide. So, using the same notion as in the previous two examples, an asset is undervalued if the price you pay is less than the present value of all expected future cash flows. Yes, and when an asset is undervalued, buy it. An asset is overvalued if its price is higher than the present value of all future cash flows, and if it's fairly valued if those two are equal to each other. In this active learning exercise, I want you to value a share of stock. Let's suppose that you are thinking about buying a share of AT&T stock today. Now, you expect to be able to sell it in 3 years for $30. You receive a $1 dividend at the end of each of those 3 years. Now, if the prevailing interest rate is 10%, how much would you value that share of AT&T stock today? Please take a minute to do all your calculations and submit your answers on Top Hat. Thank you for your responses. Now let's think about the information in this particular problem. First, the cash flow. You will receive $1 1 year from today. In present value, that's equal to 91 cents, or you need 91 cents today to receive $1 1 year from today. Now, another cash flow you'll receive is $1 2 years from today. In present value terms, that's equal to 83 cents. Another $1 3 years from today, and that value is 75 cents in present value. And lastly, $30 in 3 years from today. That in present value is $22.56. So adding up all of these cash flows in present value, the amount of money that you would have to put in a bank account today in order to replicate that cash flow is $25.03. So if it was me and the stock is cheaper than $25.03, I would buy it. There's a problem though with asset valuation, and I hope you noticed that when I presented the scenario before, I mentioned the word expectation, or you expect something in the future. When you buy an asset, you don't know what the future cash flows or the future selling price will be. Inherently, it is all a calculation about unknowns. So in order to help us understand the company fundamentals, analysts do what we call fundamental analysis. They look at a company's accounting statements and evaluate its future prospects to understand whether or not the company will be successful and how much their company may be worth in the future. Now, as I mentioned, this is an assessment of risk of future earnings, and at best it is a good guess, but nothing else. Nobody really knows the future. This fact has been eluded by many economists. Keynes believed that stock prices were driven by animal spirits and waves of pessimism and optimism. Alan Greenspan, thinking about the 1990 stock market, called it irrational exuberance. So, stock market valuation should be approached with caution, understanding that there are many unknowns about the future, and just making sure that we understand the risk inherent in these kind of investments.